Right. Morning, everyone. Welcome back to our morning kappa. Hope you had a very great weekend. So looking at the Hang Seng Index futures, it's continued to move on the upside, and we do see that last Friday, the Hang Seng have charted a wide, long bullish tick that has actually firmed up its position above the 23,000 point level. So we have unchanged stop loss point of 23,000 point, and we continue to keep our bullish trading bias unchanged. And right now, we can see that the index is heading towards 26,000 and followed by the 27,000 point level. So meanwhile, since the market is bullish right now in the Hong Kong market, so what are the stocks that give us opportunities? These are the watch lists that I have, and particularly look at one counter that I mentioned last week was Kingsoft Cloud. Then on also a few counters that we have published reports such as CSC, SMPT, VS Tech, right? And today we have found two opportunities. Firstly, the Weichai Power 2338 that are eyeing to break past the resistance at 17 Hong Kong dollar. So if the breakout happen, then Weichai will be climbing towards 18 and followed by 19 Hong Kong dollar. Secondly, we have the China Life Insurance 2628 that have break past the 19 Hong Kong dollar resistance on the back of high volume. So after the breakout, China Life will be testing the next resistance at 20 Hong Kong dollar 50 cents and followed by 22 Hong Kong dollar. Downside support is at 17 Hong Kong dollar 50 cents. So these are the two stocks that fall under the Hong Kong index that you can actually take a look. And so over the week, there are three pieces of news that market was looking at. Firstly, Trump have mentioned that it may impose tariff on Russia if there's no Ukraine deal made in the next 50 days, which is somewhere before September. Then on the NVIDIA have resumed their export to China with their lower, lesser advanced chip, which is the H20, right? And then on the right now, we're also looking at what would be the tariff that US is going to have between the US and Europe, right? Latest, right, Trump have mentioned that it's going to be a 30% tax, but right now, at the last, he's looking at a minimum of 15 to 20%. Okay, and despite that, there's a tariff talk between the US and Europe. Both the Europe SSSP as well as the US index continue to show bullish momentum, especially the US market. XPX have record closing right now, buoyed by the technology stocks. And so these are some of the stocks that are under our watch list for the US market. So one particular stocks that I want to bring your attention is the C Limited, which is the on the retail market. So look at the C Limited. This is what we have published last week as well. The stock is heading towards our first resistance at 170. So if the breakout happen, it may climb towards a 180 higher resistance. So apart from the technology tech stocks, you can look at another internet retailer, which is the C Limited. So as for the Malaysian market, our index continue to struggle or consolidate below the 1550 point level. But as of the last week, Thursday and Friday, the index have charted a bullish candlestick, eyeing to resume the upside movement to test this resistance at 1550. Now, so far, we still keep a bearish trading bias until we see a bullish breakout upon the 1550 level. Now, for the FCPO, it charged higher last Friday. It break past the 4,003 threshold, and right now it's eyeing to test the 4,004 and followed by the 4,005 resistance level. So meanwhile, the downside support is at 4,002 and followed by 4,001, and we have raised our stop loss point to the 4,001 from 4,000. So we keep a bullish trading bias on the FCPO since the momentum, bullish momentum is strong right now. Now, as for the Malaysia stocks, these are some of the watch lists that we are prepared for you. Nothing much change since last Friday, but today we'll add on two interesting counters. Last week, the momentum should continue, and likelihood the IGM may test ringgit or even higher at somewhere 3.10. So on the support level, we'll be looking at the first support at 265 and followed by 250. Now, these two level you can use it as a support level. But right now, in terms of momentum, JAM is pretty strong right now. And if you're looking at the Adams report, RJM is actually looking for bidding some data center projects recently. Now, looking at the SNS network, we also have a report, I think a few weeks back, and right now the SNS have breached past the 55 cents resistance. So after the breakout, right now the SNS will be testing the 60 cents and followed by the 65 cents resistance. Okay. So apart from these two today our report we have the critical holdings of CHP, which have break past their 1 ringgit resistance. So after a breakout, CHP will be testing their 1 ringgit 6 cents and followed by 1 ringgit 12 cents. The also support is 94 cents. Secondly, we have the constructions player, MRCB, Malaysian Resources Corporations, also a break past resistance of 56 cents. So after breakout, MRCB will be testing the 59 cents and followed by the 61 cents. Downside support is at 53 cent and half. Okay, so we have one critical holdings, MEP service provider in the data center, and as well as the constructions, which is the MRCB. Okay, I'll stop here and pass on to Yee Sian on the weekly economic updates. Thank you.
Thanks. So, morning everyone. So, I would like to start our briefing on the Econs Weekly, which was published on last Friday. So basically, after a long 2 week, we are seeing a decline in the risk appetite. So we do advocate consolidating some risk into quality assets over the next 2 weeks, following the downtick signal in our proprietary indicator. So market appetite has, according to our proprietary risk sentiment index, softened heading into the end of last week, and rightly so, given the potential exacerbation of US import tariff rates in the next few weeks. Specifically, equity flows have consolidated lower as investors pencil two key dates when US tariff exemption will expire. So 1st August on its trading partner excluding China, and also 12th of August for China specifically. So beyond these dates, recent rhetoric by the White House citing increased sectoral tariffs, especially on semiconductors and pharmaceuticals by the end of July, if implemented, will actually further dampen the sentiments. So the hope perhaps is that TARA, which is a tariff delay again, may continue to take shape post 1st of August and result in firstly, further delays in tariff implementation to facilitate cross-country negotiation and or with the tariff discounts lower than what was initially announced. For example, Indonesia received a smaller tariff rate of 19%. So recently, you have also seen that Fed speak has getting vocal on the rate cuts. So we still maintain our view of two Fed fund rate cuts at the end of 2025 with a balance of risk leaning towards one or no rate cut. So note that the recent Fed speak, specifically the Federal Reserve Governor Christopher Waller, who argued for a quarter point rate cut as early as 30 July, citing that upside risks to inflation are limited, while the Fed should not wait until the labor market deteriorates. Waller's view, however, differs materially from most of his colleagues, who have cited that US labor landscape as robust. So market swap pricing had not changed since Waller's comment, with traders still pricing in no cuts in July and a 60% probability of a 25 basis point cut in the September meeting. So last week we also see that recent GDP data released for second quarter, particularly from Malaysia and Singapore, and also vastly exceeded the market expectations, so underscoring the overall still positive prognosis for ASEAN in the year ahead. So specifically for Malaysia, second quarter advanced GDP has expanded by 4.5%, so surpassing our forecast of 4.2% and just translating into growth at 4.4% in the first half. So we still maintain Malaysia full year GDP growth at 4.2% for this year. So with the assumption that second half GDP growth will average at 4%. So for Singapore, we keep our annual GDP growth outlook at 2% for 2025, with the risk tilted towards 3%, should the tariff risk escalate after the 1st of August. So central bank rate cuts by Bank of Indonesia and Bank Negara Malaysia in recent months should further support the economic growth through increased consumption and also investment patterns as well. So on Malaysia end, so second quarter, Malaysia advanced GDP, as I mentioned earlier, has expanded by 4.2%. So surpassing ours and market consensus forecast of 4.2%. So first half, we are getting a GDP growth of around 4.4%. So according to the official data. So however, we still keep Malaysia full year GDP growth forecast at 4.2%, with the assumption of second half GDP growth to average at 4.4. So for the upcoming final second quarter GDP release of 15 August, so just before that, just to mention that this round of advanced GDP estimates actually take into consideration the data of April to May. For the upcoming final second quarter GDP release on 15 August, it actually take into consideration the data of June as well, which for the period of April to June. So we do expect that there might be a softer print of around 4.3% versus 4.5% in the advanced estimates. So the reason is because we are seeing that there's a weaker June straight data, so compared to the advanced estimates. So as also further supported by our RHB Malaysia leading index as well. So on the tariffs end, so including the potential spillover impact, so the latest adjustment of US tariff policies to Malaysia, which means that by conservative will be around 25%, so could actually reduce Malaysia's GDP by approximately up to 0.46 percentage points. So the total impact of US tariff measures actually will actually take into account of 5 key transmissions, so which including the direct tariff impact from the US, and then also the US tariff on China, which will have a spillover impact on Malaysia, potential demand slowdown in both US and China economies, and also changes in the global E&E demand as proxy by the global semiconductor demand. So sectors with a strong export orientation, such as E&E, crude materials, and machinery, are expected to bear the brunt of both direct US tariff on Malaysia and also spillover effects from the ongoing trade tensions. So hence for now, at this stage, we still maintain our relatively conservative view on the trade outlook for Malaysia and also stay cautious on the potential impact on Malaysia economy. So however, we still maintain our view that certain domestic oriented industry are relatively shielded from these external uncertainties. For example, sectors such as consumer goods, construction, healthcare, education, and utilities are largely driven by local demand and are less disrupted, are less dependent, on the global economic environment. So, and then these industry primarily serve the domestic market, make them less vulnerable to international disruptions as well. So that's for Malaysia economy. So on the last Friday itself, we're also seeing we're also seeing the official release of Malaysia trade data for the month of June. So where the June's export has declined by 3.5%, so decline further versus a May decline of 1.1%. So this is also lower than market consensus view of 5.4% and our in-house projection of 3.5%. So this also further reinforces our cautious view on the trade outlook due to global trade and tariff uncertainties ahead as well. So softer trade momentum is anticipated as the effects of front-loading activities has diminished, as we see from May's and June's trade data. However, Malaysia is still negotiating a deal to lower tariff to the US ahead of the 1st August deadline, so suggesting that there might be some glimpse of hope for the eventual tariff to be lowered from the proposed 25%. So basically, negotiation for now has focused on 3 main areas, including industrial products, agricultural products, and non-tariff barriers. So progress has been made on industrial and agricultural products. So the ongoing negotiation with US will primarily address some of the unresolved issues as well, such as matters related to non-tariff barriers, labor and environmental standards, and economic security. So sector-specific negotiation will include semiconductors, E&E, plastics, aluminium, and automotive. So most of which Malaysia's major export items to the US. So that's all from me. I'll just stop here and pass the line to the next presenter. Thank you.
Okay, morning everyone. We have a consumer strategy today. We are still maintaining our neutral sector call. Overall, we think that the growth numbers for the consumer company could moderate in second quarter, particularly for the consumer retailers, following a solid start in first quarter that was aided by the earlier timing of Raya. And looking beyond the immediate term, we foresee consumer sentiment to stay soft, given the elevated inflationary pressure, as well as the uncertain economic and income outlook stemming from the global trade tension. As such, the inflation-wary consumers will continue to spend selectively, prioritizing essential purchases and bargain hunt for value, hence capping the discretionary spending. Meanwhile, all eyes will be on the imminent implementation of petrol subsidy rationalization later this year to gauge if the actual impact on the consumer spending will be restricted. For the cost side of things, given the rising operating cost environment from the SST expansion, electricity tariff revision, EPF contribution for foreign workers, we doubt the companies will be able to fully pass on the additional costs considering the demand elasticity and anti-profiteering regulation in place. Hence, we think that margin trend could turn subdued, particularly for the retailers such as Aeon, Padini, MyNews, and Focus Point, unless there is a significant efficiency gain to offset the impact. On the other hand, things are turning more favorable for the food manufacturers like Nestle, Farm Fresh, and Power Road, given the easing commodity prices and strengthening of ringgit should translate into a more promising market outlook. Generally, we think that the sector provide a defensive shelter from the uncertain global macroeconomic outlook, thanks to the domestic centric earnings base and resilient consumption on stable employment and continuous fiscal support. However, the prospect of subdued consumer sentiment and rising OPEX will cap earning growth. Therefore, we strategically advocate for the liquid large cap retailers with better earnings visibility, backed by superior operational scale and efficiency. All in, we keep our neutral sector call. Our top picks are Mr. DIY, 99 Speedmart, Guangchong, Farm Fresh, and Focus Point. That's all from me. I'll pass on to the next presenter. Thanks.
We move on to seizing coverage notes on the Globetronics technology. So basically, we are seizing the coverage on the stock due to reallocations of internal resources. Separately, some comments on the announcements of its acquisitions of Empire Global. I think last Friday they announced that they spent 45.1 million to acquire about 30.8 to 30.9% of stake in Empire Global Berhad, as well as two separate transactions on Warren C. Total about 45.3% of its total outstanding, as well as 8.7% of its total outstanding of Warren C. Via both off-market and also open market transactions. The transacted price was 11 cents per share for ordinary share, whereas for Warren C was 9 cents per share. Notably that Warren C is currently out of money with an exercise price of 15 cents and is expiring on the 31st of May 2030. They fund this acquisitions using internal resources. In terms of valuation implication, in the purchase price of 11 cents per share for the ordinary stocks, translate to a rather steep 4.6 times price to book, based on its book value of 31.5 million as of 31st of March 2025. Now,
they have been loss making for the past 4 years. I think they also disclosed. Globetronics also disclosed that they further invested additional 15 million in undisclosed coded securities over the past 12 months. In total, all these investments amounted to 60.1 million, which is equivalent to about 19.5% of Globetronics' latest consolidated net assets. We view the acquisitions negatively, as given the lack of clear synergies between an OSAT player in technology space and Empire core business in property construction development, as well as fluid management solutions. Of course, the acquisitions valuations appears to be unattractive. Of that comment, I think this is our last piece of report on Globetronics. Our last recommendation was a neutral call with a target price of 44 cents, and should no longer rely upon as an investment reference going forward. I think that's all from us this morning. Thank you for joining us, and I will see you tomorrow.